Investors and traders, welcome to the channel Market Chart Pattern. In this video segment, we are going to take a look at the US bond futures. We'll be taking a look at the long bond futures, which is the 30-year duration Treasury bond futures, and we will also be taking a look at the 10-year duration Treasury notes. This is going to be a segment which I will be following regularly. In addition to the video segments which we have, in which we take a look at the US key stock indices, I will be covering the bond futures in a separate segment, and then we will have our regular the US stock indices segment in separate videos, because otherwise the videos get too long. So this video is for educational purposes only, and it is not a financial advice. The bond market is much bigger than the US equity markets, and it has a lot of influence because it's very rate sensitive. So anything to do with the interest rate movements up and down has a huge impact on these bond futures, 30-year duration, 10-year duration, and further going along the line, I think I will also begin to do shorter duration bonds, the notes, for example, the 5-year notes as well. But in this video, we're just going to cover the two markets, which is the 30-year and the 10-year notes. So as you can see that this market has been going down for a long time, starting 10th of March 2020. So around the COVID time is actually when this market peaked, and the way the bonds work is the price is inversely related to the yield. So in other words, if the price is going up, the yield is going lower, and if the price is moving lower, the yield is going up. So there is more interest rates, in other words, are going higher for that bond and for its coupon payment. So it has been a steady decline. But in this, there is one key thing that we have to look at, and that is something we really like to cover in our channel, a market chart pattern, and that is the concept of market symmetry, because markets repeat over and over again. And what we have seen is that in this decline, which is about 3 years old now, in fact, a little bit over 3 years, we have had several attempts for a rally. And we can look at this was attempt one here, this was an attempt highlighted here, which is of this much magnitude. Then we had an attempt here which failed, an attempt here which failed, and then when this decline became pretty steep here, we had a rally here of this much magnitude, failed. We had a rally here, and this is now over the past 6 months or so, we have been in a sideways action. But we are also trading at some really key levels, and those are the levels that I really want to discuss in this video. So in terms of the market symmetry, what we can see is that the market rallied about this much magnitude, failed. This one was a much smaller rally, failed. Then we had a nice rally here of this much magnitude, failed. Where are we now? So what we have had is a rally which has been going on since, here we go, October of last year, so October 2022. The market rallied by this bearish symmetry, and then found strong resistance, and it moved lower. The resistance also actually came from about 50% retracement of this swing here. Let me actually draw it so that's a little bit easier to see. So 50% of this one, and then what the market did is it found some support from 61.8% Fibonacci retracement. After forming a double top here, rallied again right to the 38.2% retracement of this segment right here. So what we have going on is a level, pretty strong resistance coming in at around 133. There was a possibility that in fact this might actually be a ABCD formation which could see a correction, and in fact the price moving higher to about 137 to 138 level. But it appears that this market is actually finding resistance and in fact moving, is range bound, so it's trading in a range. Let me try drawing that for you. Here we go. So this resistance coming in from this 38.2% Fibonacci retracement, and also 50% a little bit below that, seems to be pretty heavy on it. What we are really watching carefully is that if this lower boundary of this range, the market breaks out of it to the downside, and if that breakout was sustained, then we could have actually a symmetric move where we could see, the market moving lower quite a bit, and we could, and then what we'll be looking at is that perhaps it's gonna go and move to 61.8% to even 78.6% Fibonacci retracements, and it will mean that interest rates, what the market is anticipating is higher interest rates. So since over the last 6 months or so, in fact more than 6 months, starting October of last year, the rally, what it means is that market was anticipating that Federal Reserve is going to pause with their interest rates, or they will turn a little bit more dovish, which they seem to have. But if this lower boundary is actually broken down from this range, then it signifies that market is actually perhaps recalibrating, and it could be because of the debt ceiling stuff which is going on, and that could be the reason that the bonds are actually selling off, and in fact the yields are rising. But from a technical perspective, this is what we are looking at. This 38.2% Fibonacci retracement seems to have been a pretty strong one, because look, from the 6th of April, over a 1 month period in terms of calendar trading days, excuse me, the calendar days, the market has just gone nowhere. It's just been in a strong trading range, and now it's right banging on the lower end of this range again, and we have had one, two, three attempts, and the fourth time perhaps it could break to the downside, and which would it mean, what it will mean is that this has been in fact a double top here, coming right at 38.2% Fibonacci retracement, and it will imply higher interest rates, which will then obviously have impact on currency markets, because they're also very interest rate sensitive. It's going to have an impact on the equity markets as well, because lower yields means that uh, interest rates likely to move lower, or the Fed is going to be not as aggressive, and what it means is higher prices for the stocks, and vice versa. If the interest rates begin to move higher, it would put pressure on major stock indices for equities. Now, let's take a look at the 10-year Treasury note. So just like the 10-year Treasury note, excuse me, the 30-year bond, this is the 10-year Treasury note. Over here, the patterns are a little bit more clear. It's a much bigger market than the Treasury bond market, the 30-year. And if you happen to be trading these, what you will also note is that the bonds are actually, there is more volatility in the bonds, the 30-year long bond futures, and then the Treasury note market. The Treasury note, they move pretty slowly in terms of intraday basis, but these days even these are moving. There's fair amount of movement in these on daily basis, but the bonds are a little bit more volatile. So what we are looking at is just like what we saw in the 30-year Treasury bond, long bond futures. This one also topped on 10th of March 2020, and we have seen a significant downtrend, which means yields going up. And here there have been attempts for a rally. I found resistance at 38.2% Fibonacci retracement. This rally was just not big enough, found resistance, And then the similar concept of market symmetry, I'm highlighting two of these here. So we have had a market rally of this much magnitude. It failed right at the 38.2% Fibonacci retracement. In fact, this one where the failure happened was also 38.2% Fibonacci retracement. In fact, it went and formed a double top. Um, Same thing happening here. What we have going on is we have a 61.8% Fibonacci retracement coming from this high, a 38.2% Fibonacci retracement coming from this high, and we have got this bearish symmetry right here. So there's a confluence of number of things, and that's why we see this market just in a sideways trading range. So it's range bound. Let's draw this range to illustrate it clearly. There we go. And what we are looking at is that we have seen a sell-off for 1 day, 2 day, 3 day, and yesterday, um, the 9th of May, what we have seen is a small candlestick, which is kind of a doji formation, so not too much happening. And where it is right at the moment, here we go, sitting right at the 61.8% Fibonacci retracement. It's really important that this support zone of 78.6% coming at 114.18 and 115.03, the market is able to actually keep this as support level. Otherwise, just like the bonds, we might be looking at a scenario where it's going to go and test the lower end of the range, and if it breaks out to the downside, like, that's an indication that market is expecting the rates to actually move higher. Now, all of this stuff might actually be, or might have to do something with the debt ceiling stuff going on. um, I don't know in terms of fundamentals, but what we can look at is that the market since 20th of March has gone nowhere. It's just been in a sideways range. And whenever, when the markets go uh, in a range for, fairly extended time, the breakouts in either direction are usually fairly explosive. So it's just an indication that it's like a calm before the storm. We have to be paying really close attention to these levels that and these pattern formations that we are looking at here. So guys, this is what we are watching in the bond markets, United States bond markets. We have covered the long bond futures, 30-year bonds futures, and also the 10-year Treasury note. And the implication is that the bond prices move inversely. So if the prices begin to move lower, indicating that the yields are going higher, this would actually indicate that the market is perhaps pricing in further interest rate hikes. And higher interest rates are not going to be very good for the stocks, particularly those stocks which are like tech stocks, where these are dependent upon a lot of financing, for example. Uh, that's why we need to be also watching the bond market really carefully, because it has huge implications in terms of interest rates on other markets. So guys, this is what we're looking at. If you like the way we do our analysis, please do subscribe to the channel. And if you found this video of educational value, then please do press the like button. Thank you very much. Good luck and good trading.